Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I am your host, Steve Hemoen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Incorporated, a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. The federal government has decided to delay the implementation of its planned increase to the capital gains inclusion rate until January 1st, 2026. Originally, the increase was scheduled for June 25th, 2024. This decision was announced by Finance Minister Dominic LeBlanc, who stated that the delay aims to provide certainty as the tax season approaches. The inclusion rate was set to rise from 50% to 66.7% for individuals earning over $250,000 in annual capital gains, as well as for corporations and most types of trusts. This policy change was initially introduced in Budget 2024, but it was not legislated due to the proroguing of Parliament earlier this year. With a federal election on the horizon, there is the possibility that a change in government could lead to the cancellation of this proposed increase altogether. Minister LeBlanc emphasized the government's commitment to engaging with Canadians about fiscal policies to sustain robust economic activity across the country, noting that this delay was the responsible thing to do given the current context. While this decision brings clarity ahead of the tax season, it may impact both Ottawa's and the province's fiscal outlook by delaying the expected revenue from the tax hike, which could affect their ability to meet budgetary targets in the short term. Despite the delay in the capital gains tax hike, several related measures are proceeding as planned. These include key exemptions and new thresholds designed to support Canadians and encourage investment. For instance, the principal residence exemption will remain, ensuring no capital gains tax on the sale of a primary home, keeping profits tax-free. Additionally, the lifetime capital gains exemption will increase to $1.25 million, effective June 25, 2024, reducing taxes on small business shares and farming or fishing properties. Moreover, the Canadian Entrepreneurs Incentive, effective 2025, will reduce the inclusion rate to one-third for up to $2 million in eligible gains, growing each year to $2 million by 2029. This means entrepreneurs could pay less tax on up to $6.25 million in gains, providing a significant benefit to those in the entrepreneurial sector. The rollout of the federal government's secondary suite refinancing program has been slower than anticipated, with only a handful of major lenders currently accepting applications. This program, launched on January 15th, allows homeowners to refinance up to 90% of their property's value to add rental units, such as basement apartments, in-law suites, or laneway homes. Despite the federal government's assurances, many homeowners remain uncertain about how to access the program as information has been sparse. The Canada Mortgage and Housing Corporation, which is overseeing the initiative, has advised homeowners to contact their lenders or mortgage providers for guidance. However, many brokers and lenders are still awaiting further details on how the program will be managed, resulting in a patchwork of options for those interested in the refinancing initiative. Among the major banks, only the Bank of Montreal, Royal Bank of Canada, and National Bank have confirmed their participation in the program. Customers with these banks can reach out to a mortgage specialist to inquire about the program, determine its suitability, and begin the application process. Other banks, including Scotiabank, TD, and CIBC, have either put the program on hold or are reviewing it until further guidance is provided by the Canada Mortgage and Housing Corporation. For those considering smaller lenders, there are some options available. Coast Capital, a credit union based in British Columbia, has confirmed that they are currently offering the program. Homeowners interested in applying through smaller lenders should contact their mortgage specialists for more information. While Canadian Mortgage Trends continues to monitor the situation, it is recommended that brokers and homeowners contact their lenders directly to confirm the availability of the program. As the rollout progresses, It will be crucial for lenders to provide clear information to ensure that homeowners can take full advantage of this refinancing opportunity. Interest rates may be on the way down, both on the fixed and variable sides, but many hopeful homebuyers are still finding it difficult to navigate the mortgage application process. This is particularly true in challenging markets like Ontario and Vancouver, where affordability constraints remain a significant barrier. According to a recent report by the Royal Bank of Canada, while the housing market embarked on a recovery path in 2024, it is expected to encounter ongoing challenges. Rising debt levels and the overall cost of living continue to put pressure on budgets, leaving many potential buyers struggling to meet lender requirements. Krista Tessier, a mortgage advisor's broker and co-owner, highlighted that limited savings and higher debt-to-income ratios are common hurdles faced by mortgage shoppers today. Tessier emphasizes that good financial habits should begin well before the mortgage application process starts. She advises borrowers to focus on reducing debt and maintaining good credit habits, such as paying bills on time and keeping credit utilization low. Additionally, creating a budget that reflects the financial reality of homeownership and saving diligently for a down payment, closing costs, and a financial cushion can make a significant difference. Brokers play a crucial role in guiding clients through these preparations. Tessier advises against overextending on credit, which can negatively impact a borrower's debt-to-income ratio and their ability to handle unexpected expenses post-purchase. It is vital for borrowers to understand that lenders closely scrutinize their overall financial health, making it doubly important to avoid taking on new credit obligations before applying. The lending landscape has become increasingly complex, and brokers must be well-versed with lender guidelines and exceptions. Tessier points out that understanding which lenders are more flexible on certain criteria, accurately calculating usable income, and knowing when to extend ratios based on a client's profile are essential to successfully packaging a deal. Misaligning an application with the right lender's requirements can lead to unnecessary declines and delays. Looking ahead, the Bank of Canada's recent decision to cut its benchmark rate by 25 basis points, marking a sixth consecutive reduction, offers some relief to variable mortgage shoppers. However, the future trajectory of rates remains uncertain, partly dependent on international factors such as potential tariffs from the United States. Tessier notes that stabilizing or further declining rates could enhance affordability for Canadian borrowers. Additionally, new programs like expanded access to 30-year amortizations and a higher insured mortgage cap may contribute to a more favorable home buying environment. However, the potential for rising home prices could counteract these measures, maintaining affordability challenges for many buyers. High housing costs in Canada are posing significant challenges to the country's economic growth, according to Aled Abiorworth, the Deputy Chief Economist of the Canada Mortgage and Housing Corporation, CMHC. The elevated cost of living in major cities is deterring individuals from relocating to areas with better job opportunities, thus limiting economic potential and productivity growth. Aled Abiorworth explained that the rising cost of housing has become a considerable barrier to population mobility, impacting both job seekers and employers. Recent studies indicate that even a modest increase of 1% in house prices within a destination city can lead to a more than 1% decline in the number of people willing to move there. This effect restricts workers from accessing higher-paying positions and stifles professional growth, ultimately reducing the vibrancy and economic development of major cities. The issue is not solely a personal concern, but a broader economic one, as employers are compelled to offer higher salaries to attract skilled workers to high-cost locations, thereby raising operational expenses and further hindering productivity growth. Cities like Toronto and Vancouver, known for their high housing prices, are struggling to maintain their status as hubs of innovation and economic vitality. When choosing where to live and work, Canadians not only look at the wage increase they might get, they must be realistic about housing costs if they have to move to a new location, noted Abiorworth. And they may give up on opportunities offered by a new job that improves their skills and knowledge, and hence the productivity of the country, if they cannot afford to cover the cost of housing after moving. While cities like Calgary and Edmonton, which maintain relatively more affordable housing, have experienced faster population growth, Other cities with soaring housing costs have seen a decline in movement. In major cities, the ability to attract diverse, skilled workers is crucial for growth, as clusters of industries depend on a steady influx of talent. When workers are priced out of these cities, it impedes overall productivity and economic dynamism. The effects of high housing costs are also apparent in cities' efforts to accommodate growth. Without sufficient housing supply to match demand, rising prices push people away, preventing cities from reaching their full economic potential. Even within cities, high housing costs limit mobility, as workers may hesitate to accept positions in distant neighborhoods due to expensive housing and long commutes. High housing costs also discourage Canadians from moving to expensive cities, Abyorworth noted. Our cities end up smaller than they could be. Smaller cities mean less innovation, skills, and productivity growth. The issue also affects the service industry, where high housing costs force workers to move away from city centers, disrupting the broader ecosystem of services, from retail to healthcare, further diminishing economic vitality. Ultimately, high housing costs not only make it harder for Canadians to find affordable homes, but also impede job mobility, reducing the flow of skilled workers to dynamic cities. Abyorworth emphasized that to ensure long-term economic growth, cities must focus on increasing housing supply and making homes affordable. This strategic focus could potentially alleviate some of the economic constraints posed by high housing costs. Recent optimism in the housing market, spurred by interest rate cuts, could quickly dissipate if Canada finds itself embroiled in a trade war with the United States, according to Ron Butler, a broker with Butler Mortgage. Butler highlighted that the imposition of tariffs on both sides of the border could alter the current positive sentiment among Canadian homebuyers. One significant factor that could influence homebuyers is the potential risk of unemployment. Bad economic news is bad for housing, Butler stated in a recent interview with the Financial Post's Larissa Harapin. People are always going to be cautious about buying a house if they think their jobs could be in jeopardy. The situation has been further complicated by U.S. President Donald Trump's threat to impose a 25% tariff on all imports from Canada and Mexico starting February 1st, unless the two countries enhance their border security measures. In response, Canada has vowed to retaliate with equivalent measures. Butler pointed out that the uncertainty surrounding these tariffs could also affect Canadians' interest in variable rate mortgages. "We just do not know what the outcome of these tariffs could be," he said. "It could be terrible. It could be just not great." Additionally, low construction activity over the past year in major markets like Ontario and British Columbia could further impact home sales. "Virtually there is nothing to buy," Butler noted, emphasizing the limited availability of new homes. The outlook for the condominium market over the next 12 months appears lackluster, particularly in southern Ontario. Butler attributed this to the fact that many condos purchased 5 or 6 years ago are now coming to completion and are considered overpriced. "It is just going to get worse. It is very clear that it gets a little bit worse every day," Butler remarked, drawing a parallel with the situation in the United States, where high interest rates are similarly suppressing home sales. In the U.S., new home sales have experienced a decline similar to parts of Canada, as high interest rates continue to deter buyers. Butler's observations underline the interconnectedness of economic factors across borders and their potential impact on housing markets. Canada's real gross domestic product fell by 0.2% in November, marking the largest monthly decline since December 2023, according to Statistics Canada. This decline comes after a 0.3% increase in October, with 13 out of 20 sectors experiencing downturns in November. The goods-producing industries saw a drop of 0.6%, while the services-producing industries decreased by 0.1%, ending 5 consecutive months of growth. Notably, the sectors that experienced the most significant pullbacks included mining, quarrying, and oil and gas extraction, which fell by 1.6%, support activities for mining and oil and gas extraction, which plummeted by 4.6%, utilities, which decreased by 3.6%, and transportation and warehousing, which fell by 1.3%. Statistics Canada noted that the Postal Service subsector experienced a substantial decline of 20.3% in November. This drop coincided with a strike involving approximately 55,000 postal workers that began on November 15th. On a more positive note, the real estate and rental leasing sector increased by 0.3% in November, marking its seventh consecutive monthly increase. Additionally, the construction sector saw an uptick of 0.7%, with residential building construction rising by 1.8% for the fourth consecutive month. Looking ahead, December is projected to see a rebound in GDP. Benjamin Reitzes from the Bank of Montreal suggests that Statistics Canada's early estimate for December GDP is a positive 0.2%, largely driven by retail activity during the tax holiday. However, there are noted weaknesses in housing, transportation and warehousing, and wholesale sectors. Mark Erkelau, an economist at TD Economics, points out that the economy is tracking on point with the Bank of Canada's recent projection of 1.8% annual growth for the fourth quarter. StatCan's advance information estimate will be updated on February 28th, when the official GDP release for December 2024 is scheduled. Despite the weakness observed in November, the focus has shifted to the potential impact of United States tariffs, which economists suggest is a more pressing concern at the moment. Benjamin Reitzes notes that everyone is on tariff watch, indicating that the near-term economic outlook is heavily influenced by these potential trade measures. Regarding future monetary policy, Mark Erkelau believes that the Bank of Canada has significant challenges ahead. Following recent interest rate cuts, the bank is now awaiting further details on the tariff implementation plan from the United States, which could be unveiled as early as tomorrow. Erkelau suggests that while the bank might pause rate changes at their March meeting, expedited rate cuts could be necessary if a severe trade war ensues. In recent news, the Government of Canada is set to make a significant housing-related announcement in Lakeshore, Ontario. This announcement is part of the government's ongoing efforts to address housing challenges across the nation. While specific details of the announcement are yet to be disclosed, it is expected to focus on initiatives aimed at improving housing affordability and accessibility for Canadians. The event is scheduled to take place on February 5th, 2025, and will feature key government officials, including the Minister of Housing and Diversity and Inclusion, alongside representatives from local housing organizations. This gathering underscores the collaborative effort between federal and local authorities to tackle the pressing housing issues facing communities in Ontario and beyond. The announcement comes at a time when the Canadian housing market is grappling with high costs and limited supply, challenges that have been exacerbated by economic fluctuations and evolving demographic trends. The government's initiative is anticipated to address these challenges by introducing measures that support the construction of affordable housing units and provide assistance to first-time homebuyers. As we await further details from the government, this announcement is a reminder of the critical importance of housing policy in shaping the economic and social landscape of our cities. It also highlights the need for continued investment in housing infrastructure to ensure that all Canadians have access to safe and affordable homes. We will continue to monitor this story and provide updates as more information becomes available following the official announcement. Stay tuned for further developments in this vital sector of Canada's economy.